Financial Accounting 9, Intangible Assets, Research and Development Expense. This is Ken Boyd, the owner of St. Louis Test Preparation. Here's our Facebook page, our LinkedIn group, MBA Accounting and Finance, and a reference is the 14th edition of the Intermediate Accounting book by Kiso, Wygant, and Warfield. What I would like to do is advance to the problem that a student gave me, and I'm going to rotate this because there are two specific problems that I'd like to talk about. And the first one is 2-12, which is here. Classification issues with intangibles. So it says presented below is select information related to a company. They all have debit balance, so if they're assets, their normal balance is a debit balance. What the student is asked in the question is identify which items should be classified as intangible assets. And for those that aren't, tell us where they be reported in the financial statement. So let's go back to the answer to that question. And if you have the slides for this textbook, you'll see that you got a couple of tips here. Intangible assets lack physical existence. You can't touch, see, or feel them like vehicles, equipment, or buildings. And also, they're not financial instruments, which is a common misconception. We capitalize costs to prepare the intangible asset for use. So if we go out and buy a brand name from somebody and we have to pay lawyers and accountants, we would capitalize or include the cost of the lawyers and the accountants in the asset. If we internally generate something that's an intangible asset, a patent or copyright, we only capitalize the legal cost. Everything else gets immediately expensed if we internally generate it. So examples of intangible assets, anything creative, a franchise, music copyright, Goodwill, which is paying more than the fair value of an asset that you buy, contract rights, customer lists, non-compete clauses. This is a common one that comes up. Non-compete clauses are common in business. If you leave an organization to get a payout, there may be a non-compete clause. That's an intangible asset. Brand names, if Coke buys Pepsi, for example. The other ones here are not intangible assets. R&D costs are immediately expensed. Some of these are pretty obvious and I won't cover all of them. Organizational costs. That's another one that can be a question mark and it takes a little more work than the scope of this video. An investment in an affiliate is not an intangible asset, it's a current asset. So if company's parent invests in company subsidiary, that's a current asset. Let's skip over to the next question that was asked. So I'm going to go down a page and I'm going to rotate this problem. And this is a problem that takes entries that are made into an asset account. And what we're trying to do is to determine if the entries that were made were proper or not. So here's the question that we're asked. It's 12-5. So an auditor is looking at an account, and the account happens to be the asset account, intangible assets. And we see these entries that are made in January through June 30th in the intangible asset account. We debited an account called Research and Development. We increased intangibles for legal costs to obtain a patent. We prepaid some rent. We debited intangible assets for that. We issued stock, and the premium over the par value of the stock was credited to intangible assets. We have an unamortized discount on a bond that we issued. We debited intangible assets. We had promotion expenses to promote a business we started, debited intangible assets, and we had an operating loss that we debited. And the question is, are these entries, or these journal entries, correct? Let's go to 12-5 on the tab. Well, R&D expenses should be removed from intangibles. We should debit to expense R&D and credit to reduce intangibles. Prepaid rent should be removed. That's a separate asset account that has nothing to do with intangibles. So we debit to increase prepaid rent. We credit intangibles to remove it from intangible assets. The February 11th entry reminds us that financial instruments, generally stocks and bonds, are not intangible assets. The original entry that I was describing was something like, we issue common stock credit, we have additional paid-in capital credit, and we debit cash for issuing stock. So our adjusting entry, and I've got a typo here, should be, if I scoot down just a little bit, we should have credited additional paid-in capital and not intangible assets. So we would debit to get rid of that. March 31st, same thing. Financial instruments, stocks and bonds, are not intangible assets. Therefore, that discount on bond payable should not be in intangible assets. What the entry should have been was, we issue a bond. Here's the face amount, 120. I'm making numbers up just to illustrate. We get cash in the door. The difference between the cash we get and the liability we set up is a discount on bond payable. That is not an intangible asset because it has to do with a bond that's a financial instrument. So our adjusting entry is, we debit discount on bond payable and we credit intangible assets to remove it from intangible assets by crediting. Advertising and marketing costs should be immediately expensed even if it relates to starting a business. So we should reduce by crediting the intangible asset, and we should set up an account called something like promotion expense. It's an expense account. The last one, any sort of income statement loss or gain should not go in the intangible asset account. So we're crediting to remove it from intangible assets, and we debit operating losses. One thing that I added for the student was, we did not amortize the patent expense if we would have slid down a little too much. If we would have set up an intangible asset called patent, we would expense it by amortizing it each year. I did not make an entry for that for the student because a full year hadn't gone by yet. Just so the professor knew that I realized that intangible assets might be amortized, but I haven't done it because an entire year has not passed yet. One more thing I'll add on is Goodwill. Just as a reminder on Goodwill, we take the book value of the assets, we look at the fair value of the assets, and the difference between those two will consist of fair market value adjustments, up or down. In this case, land fair value was higher, equipment fair value was lower. It netted out to a $45,000 increase between book value and fair value. The purchase price that we pay above fair value, we consider that goodwill by definition, the amount paid over fair market value. So the journal entry would be, we're going to debit all the assets and credit liabilities for their fair value. Land was increased to $70,000. Equipment was decreased. Once we set that up, we record the purchase price as a credit to cash, and to make the entry balance, we need to debit to an account to make the total debits equal total credits, and that debit is going to be to an account called Goodwill, because if we enter that, we have total debits equal total credits, and the purpose of this entry is to record company purchase and goodwill created. Goodwill is an intangible asset, which is why that question was included in this set. That's as far as we're going to get on Financial Accounting 9. Are not on the web, or additional videos and spreadsheets not on YouTube. The YouTube channel is Ken Boyd STL. You can email for a complete list of videos on YouTube. Here is the website, the email address, and the phone number. Thanks very much, and we'll see you next time.